All right, hi everyone. Today I'll be teaching you a bit more about investing. And first of all, we'll take a look at why you should invest. Then we're going to take a look at some investment possibilities, like some things you can invest in, and then I'll give you some tips in the end. So let's dive right into it. Why should you invest? So we're going to compare investments versus just a savings account. So in a savings account, your money is just there. You don't gain anything except like maybe the 0.1% interest you get from your bank, but that's basically nothing. And because of inflation, your money just becomes less and less valuable. So inflation just eats away your money. So let's take a look now at investments. Why would you invest? First of all, investing is a pretty good way to make money. It won't get you rich overnight, but if you start investing at a young age, it will definitely help you become more wealthy later on in your life. So, step one is make wealth for later. And the second part of it would be to beat inflation, as we just talked about. So, we want to make sure that we have more money than we started with, and that inflation does not just take away our money. So let's look at an example of this, just like why investing is so important. So let's say we have $10,000, and if we would just leave it in our bank account, um, because of inflation, which has like an annual rate of around 3.10%. So every single year you're losing 3.10% of your money. You'll still have $10,000, but that $10,000 will be worth less because everything else becomes more expensive. So let's see. We have a pretty nice formula to calculate like what it will be worth in, let's say, 5 or 10 years. So the value of those $10,000 then is the value that it is at now. So initial value times 1 plus the return per year. We're going to look at it per year now. That is in percent to the power of the years that we let it go. So let's see. We have $10,000, one plus, but this wouldn't be a plus because inflation takes away our money, so it would be minus 0.031. And let's do 5 years now. So after 5 years, if we plug this into our calculator, we can see that it would be power 5, that it would only be worth 8,400 $543. So let's say after 10 years, we can easily calculate that as well. It would only be worth $7,298. So if you see this, this is a pretty substantial part of your wealth is just gone. So that's almost $3,000 over the span of 10 years. So that's quite a lot of money if you just leave it in the bank. Now, let's take a look at if you would invest that money. So, if you would invest, let's say in the S&P 500, you would have an annual return of around 10% on average over a long time span. So it's not 3.10, but it is 10 now, and we just change the values. So this would be 10,000, 1 plus 0.10 times, let's say 5 for now, like this. So in 5 years, let's plug it in, that would be worth 1 plus Yeah, that would be worth 16,105. And after 10 years, that would be worth 25,937. So if you can, as you can see, after 10 years, we would have $15,000 in profit. Basically, you almost more than doubled what you had. Of course, now we didn't take into account the inflation. So if we would do that, we would have to subtract 3.10% from this. So this would become less. This whole number here would become less. And then these values would become less, but in the end, you would still make money. You would still make quite a lot of money. I think this would turn out to be 19,000 or something. So that's still almost doubling your account in 10 years. So that is quite substantial. So let's now take a look at the types of investments. So first of all, there are stocks. Stocks are pretty famous. I think everyone knows what they are. But basically, if you buy a stock, you own a part of a company. So for example, if you buy Apple stocks, you are a partial owner of Apple. Or if you buy Tesla stocks, you own part of Tesla. Because of this, for example, if you are a owner of Tesla and Tesla grows a lot in the next 5 years, you can profit off of Tesla's growth by owning Tesla stocks. So this can make us some nice bucks and just increase our wealth over time. So let's take a look at this Apple chart. Uh, as we can see, around 2014, 2015, Apple was worth about $18.5, and over time it just kept on going up, and now it is at $148.97. This is over the time span of about 7 years. So if you look at this, that's like 8 or 9x your money. So eight, maybe 9x your money in the span of 7 years. It's quite substantial if you look at it. So that's pretty nice. So the next one are funds. There are a lot of types of funds, but there are three pretty mainstream funds. The first one is a mutual fund. Mutual funds just invest in all different kinds of investing opportunities, so stocks, bonds, whatever, and they update the value of the fund every single day. So every day. And then ETFs, on the other hand, are publicly traded. So you can follow their price second to second. It'll change every second of the day because it's publicly traded on the market, and as long as the market is open, this price will fluctuate every second. And then we also have hedge funds. They try to make money in every way possible. So they don't only buy shares, they also short um, some stock. For example, the GameStop short from the hedge funds. That's what they do. And then we have an index fund. An index fund is something special. It is either a mutual fund or an ETF. So it can be one of those two. And an index fund basically follows, for example, an industry or a country or whatever. It doesn't matter. It can follow anything. And for example, if it follows a country, it will only buy shares from that country. So a good example of this is the S&P 500, as you can see on this slide. It invests in the biggest 500 biggest companies in the US, which the 15 biggest ones you can see here on screen. And while doing this, you can profit off of the growth of all these 500 companies. But let's say if one company goes bankrupt of these, that isn't that big of a deal because you have 499 other companies to compensate for the loss. So that is the big advantage of an index fund. Then we are going to take a look at bonds. Bonds are a fixed income instrument, meaning that over a certain amount of time, your returns will be fixed. So you know, like I'll get X amount of percent of interest on this. So what it basically is a loan. So for example, a company or a government that needs money for a project or whatever borrows money from investors that are willing to pay for it. So for example, they borrow $10,000 from you and they promise to pay you back, let's say, uh, 10, $12,000, for example, in 10 years. That is a bond, so you basically know for sure that you're going to get the money, but the returns will be rather minimal compared to the stock market. Then let's take a look at options. Options are pretty difficult, but a simple explanation would be that the option gives you the right to buy or sell a security at a certain price, whereas a security can be a stock or whatever. And the disadvantage of options is that they are very risky. You can make a lot of money with them, but you can also lose a lot of money. And one thing to note is that options depreciate in value over time, so your option will be worth less as time goes on. Then we're going to look at real estate. Real estate is where you would buy a property, preferably with a mortgage, and then rent out the property and pay back your mortgage plus gain some cash on it. For example, you have to pay off your mortgage, and it would be $15,000 every month. You would rent it out for, let's say, $2,000 a month, and that would be a nice $500 profit. Then we're going to look at the most risky one, but also the one with the highest reward, possibly. And that is the crypto market. The crypto market is pretty special because it's fairly young compared to the stock market, and because of this, it's very volatile. So in the crypto market, it isn't spectacular to see some cryptocurrency rise 20% in a day and fall 50% the next day. That is pretty normal, but I think over the long term, the crypto market would be a viable strategy and a good investment. So here is a big tip, and that is that you have to diversify. Don't put all of your eggs in one basket. All right? Because if you, for example, put all your money into one stock and that the company goes bankrupt, you lost all your money. A good way to counter this is by buying index funds, for example, because they spread all your money over, for example, the S&P 500 spreads it over 500 different companies. So if one goes bankrupt, you can take that loss and all the other companies will make up for it. So this was it. I hope you guys enjoyed. If you did, please leave a like and subscribe, and I'll see you next time.